Hello everybody, I'm Robert Roundtree, the Global Strategist at Eastspring Investments. World equities have been in a sustained rally since early 2016. Since then they've risen about 20%, that's including reinvested dividends. This year, however, Asian equities have really taken off and they've risen some 20% against 9% for the market as a whole. And let's not forget bonds either. They have also given positive returns, albeit lower. Treasuries in particular, US Treasuries, they've risen about 2%, which doesn't sound much, but in actual fact, it's much, much better than you can get in a bank account. Now, the good news is the drivers that are fueling these rallies are still intact, although we would expect profit taking at some stage. But as investors, we really should be considering valuations. Are the assets we're buying cheap or are they expensive? Now we're going to take a look at these, but we're going to focus on equities because at the moment that's where all the action is. Now take a look at the chart on the left. These were where the valuations were at the beginning of December last year, and that's when Asia started to pull ahead. And you can see why. They look real attractive. You see, investors had over-exaggerated and over-discounted a myriad of fears. China growth, stronger US dollar, commodity prices, and the result was they drove Asian valuations down to rock-bottom historically low levels. And this was pretty true for emerging markets in general. But all that's changed coming into 2017. Well, have a look at the chart on the right and you'll see what I mean. That's where the markets are valued today. And Asia still looks good value. Now it's clear that the low-hanging fruit has been plucked, but there's still no premium on Asian valuations despite stronger economic growth forecasts and generally stronger profit forecasts. And indeed, you can see that there are pools of deep liquidity there, deep value there, such as the China H shares, the Asian high dividend stocks, where there's very good value. But good value lies elsewhere, as you can see. Emerging markets generally are still in the attractive range. Japan looks attractive, and even the Eurozone could actually be cheaper than it seems if the aggressive profits forecasts actually deliver. And incidentally, if you do like the Eurozone, you really got to love Japan because both markets are composed very, very similarly, but Japan's valuations are so much cheaper. But if you look at the chart again, you'll see that high valuations don't necessarily stop valuations from going even higher, as in the US, which of course is being driven by profits upgrades and high liquidity. So where are we leading with all of this? Well, with few exceptions, high valuations shouldn't stop the markets from rallying further. Despite the rallies that we've seen to date, there's still very good value out there. And thank you for watching.